The Intelligent Investor, Chapters 8, 9, and 10, Navigating Volatility and Seeking the Right Help. In this video, we continue our journey through Benjamin Graham's The Intelligent Investor, focusing on Chapters 8, 9, and 10. These chapters teach us how to navigate the stock market's wild ups and downs without losing our cool, and how to wisely use outside help, from mutual funds to financial advisors, when investing. By the end, you'll understand Graham's famous Mr. Market parable, a lesson in managing our emotions, the pros and cons of investing through mutual funds, and how and when to get the right financial advice. Let's dive in with a clear narrative that links all three chapters together. Chapter 8, Riding the Market's Ups and Downs, Managing Emotions in Market Fluctuations. Imagine the stock market as a wildly mood-swinging partner. One day it's euphoric, the next it's despondent. Graham opens Chapter 8 by reminding us that market volatility is inevitable. Stock prices will soar and plunge over time, sometimes by 50% up or 33% down from recent highs and lows. Rather than fearing this, the intelligent investor prepares for it. The key is emotional discipline. Don't let the market's mood dictate your actions. Graham even personifies the market as Mr. Market, a famously useful parable. Picture this. You own a small stake in a business, and every day your partner, Mr. Market, knocks on your door offering to buy your share or sell you his, but at a different price each day, depending on how optimistic or pessimistic he feels. Sometimes the price he quotes is ridiculously high, sometimes ridiculously low. Graham's advice: you are in control. You can choose to ignore Mr. Market or take advantage of him, never the other way around. In other words, market quotations are there for your convenience, either to be taken advantage of or to be ignored. If Mr. Market's price is unreasonably low, because he's in a slump of pessimism, you can buy at a bargain. If his price is absurdly high, driven by euphoria, you might sell and take a profit. And if the price he offers doesn't make sense to you, you do nothing at all. The crucial point is not to let his mood swings drive your own emotions. Mr. Market's job is to serve you with prices. Your job is to decide if those prices work for you. You are never obligated to trade with him out of fear or excitement. Graham warns that an investor who panics during market drops or gets too excited during booms is transforming a basic advantage into a basic disadvantage. Your big advantage as an investor is that you don't have to act. So don't get stampeded into selling just because the market had an unjustified drop. That only turns temporary declines into permanent losses. Instead, embrace a long-term mindset. As long as the companies you own are performing well in their actual businesses, you can afford to tune out the market's day-to-day noise. Graham suggests focusing on the business, not the ticker price. If the company's earnings and prospects are sound, a falling stock price might just be an opportunity rather than a disaster. The intelligent investor celebrates improved business performance, not a rising stock price, meaning your mood should hinge on how the business is doing, not Mr. Market's latest quote. Practical tips from Chapter 8. First, separate speculation from investment. If you can't resist a bit of gambling in stocks, do it consciously with a small separate portion of money. Never mingle your fun trading with your serious long-term investments. Second, avoid trying to time the market swings. Graham notes that if you attempt to buy and sell based on predicting the market's next move, you're likely to drift from investor to speculator and get speculator results, usually not good. Instead of forecasting the market, a steadier approach is to buy more when the market has dropped significantly and valuations are attractive, and be cautious or take some profits when prices have run far ahead of value. This buy low, sell high approach sounds simple, but requires fortitude to execute. You have to go against the crowd's emotions. One technique Graham suggests to keep emotions in check is mechanical rebalancing of your portfolio. For example, you might decide on a target asset mix, say 50% stocks and 50% bonds for a moderate investor, or perhaps 70-30 for someone more aggressive, and then rebalance periodically. When stocks shoot up and become more than your target, say your stocks become 70% of your portfolio when you only wanted 50%, you'd sell a bit of stocks and put that money into bonds to restore the balance. When stocks plunge and drop below your target percentage, you'd buy more of them using funds from bonds to get back up to the desired mix. This forces you to sell high and buy low systematically, taking advantage of Mr. Market instead of being taken advantage of. It also removes some emotional decision-making. You're following a plan. Graham's example is a 50-50 or 75-25 stock-bond split depending on your risk comfort, and adjusting it maybe once or twice a year. The exact numbers aren't as important as the discipline. This way you profit from volatility instead of suffering from it. Finally, Chapter 8 underscores that you control certain things as an investor, and those are what you should focus on. You can't control the market's gyrations, but you can control your costs by not trading too often and avoiding high-fee investment products, your diversification and risk exposure by not putting all your money in one basket and by rebalancing as needed, and your own behavior, including tax efficiency, for instance, holding stocks long enough to pay lower taxes on gains. By keeping fees low, staying diversified, and thinking for the long term, you stack the odds in your favor no matter what Mr. Market does day to day. With this solid mindset, treating market volatility as an opportunity rather than a threat, you become much less likely to make emotional mistakes. Now that we've learned to master our reactions to market swings, what about letting professionals help with investing? That brings us to Chapter 9, which explores mutual funds as a way to have others manage some of the investing work for you. Chapter 9. The pros and cons of mutual funds, investing in investment funds. Chapter 9 shifts from your personal temperament to the investment funds you might buy. A mutual fund or investment fund is basically a pool of many investors' money managed by professionals, and it offers everyday people an easy way to own a diversified basket of stocks or bonds. Graham acknowledges that for many defensive, conservative investors, mutual funds can be a sensible choice. In fact, he guessed that the average person who put all their money in mutual funds over the past decade probably did better than the average person who picked their own stocks. Why? Because a small investor managing their own stocks might fall prey to impulsive trading or speculative tips, whereas owning a fund imposes a bit of discipline. When you buy into a good fund, you're less tempted to tinker and gamble day to day. The fund shields you from some common mistakes by diversifying your holdings and putting a pro in charge of decisions. But Graham also puts forth a reality check. Not all mutual funds are created equal, and very few consistently beat the market. Importantly, funds charge fees for their management, and those fees eat into your returns. The chapter examines whether an investor can get better than average results by choosing the right fund, and Graham's conclusion is that it's tough. He offers some sobering insights about mutual funds that remain true today. 1. Most funds don't pick stocks well enough to offset their costs. The average mutual fund, after paying for its research, trading, and management, achieves no better and often worse results than the overall market. In other words, if the market index returned 8%, an average fund might return 8% before fees, but perhaps only 6 to 7% after fees. 2. High expenses means lower returns. Funds that charge higher management fees or have high trading costs tend to deliver lower net returns to investors. Every dollar you pay a fund manager is a dollar less compounding for you. 3. Frequent trading hurts performance. Some funds trade very actively, buying and selling stocks rapidly. Graham notes that the more frequently a fund trades its holdings, the less it tends to earn for its shareholders. Active trading racks up costs and taxes, and chasing short-term moves often backfires. 4. Volatile funds remain volatile. Funds that swing up and down more than average, perhaps a sign they take big risks, are likely to continue being very volatile. If you're a conservative investor looking for steady growth, a highly volatile fund isn't magically going to turn safe. Its nature is to be rocky. 5. Hot streaks don't last. A fund that had stellar performance in the recent past is unlikely to keep outperforming for long. Chasing the latest top-performing fund is a common mistake. Last year's star fund often becomes next year's mediocre fund. Performance tends to revert to the mean over time, especially after everyone rushes into the once-winning fund. Graham even discusses the trend, back in the late 1960s, of so-called performance funds. These were fashionable mutual funds that boasted spectacular returns in bull markets by taking on lots of risk, for instance, investing in hot new companies at any price. He warns that there are special risks in looking for superior performance from fund managers. Many of those hot funds did extremely well for a while, but later led to calamitous losses when the market cycle turned. The lesson: be wary of funds that promise to beat the market by a wide margin. They might be achieving that by speculating, which can blow up. In general, large, well-established funds can at best hope to beat the market only slightly over the long run, and even that is not guaranteed. So, should we avoid funds altogether? Not at all. Graham actually believes mutual funds are a fine option for defensive investors. But you have to choose wisely and set realistic expectations. By the 1970s edition of the book, with commentary by Jason Zweig, even index funds, funds that simply mimic the market index, are praised as an excellent choice. An index fund guarantees you the market's return before a very low fee and removes the risk of underperforming due to bad stock picks. Graham later in life lauded index funds for their low costs and simplicity, a view Warren Buffett also shares. For many of us, simply buying an index fund is the easiest and most reliable path to long-term success. If you do decide to pick an actively managed mutual fund, Graham offers advice on what to look for. Don't be swayed by flashy ads or recent performance charts. Instead, focus on the fundamentals of the fund itself. According to Graham and Zweig's commentary, the best funds tend to have these traits. 1. Managers with skin in the game. Ideally, the people managing the fund are also major investors in it themselves. If the fund managers have put a lot of their own money into the fund, you can trust they'll handle the money cautiously and carefully. Their incentives align with yours. 2. Low costs. Look for a fund with low annual fees and expenses and without heavy sales charges. Every dollar not spent on fees is a dollar that stays invested for you. Many great funds are no-load funds, meaning no upfront fee to buy in. 3. A distinct, disciplined strategy. A good fund dares to be different. This means it's not just buying the same popular stocks as every other fund, which would essentially make it an expensive index. It might focus on a particular style, value stocks or small companies, etc., and stick to it with discipline. 4. Reasonable size, willing to close doors. The fund managers aren't asset gatherers looking to get as big as possible. In fact, the best funds will shut the door to new investors when they grow too large. By limiting inflows, they avoid diluting their strategy or being forced to buy stocks just to invest new money. This is a rare but very positive sign of an investor-first mentality. 5. No hyper-marketing. Be cautious of funds that advertise everywhere. Great funds often don't need to advertise. They let their track record and word of mouth attract investors. If a fund is spending big on marketing, that could be a red flag, and those costs might be indirectly passed to you. Graham cheekily notes that the best clients come to the fund, not the other way around. When evaluating a fund, Graham suggests an order of operations that's basically the opposite of how many people pick funds. Many naive investors look at a fund's recent performance first. Wow, it returned 15% last year, and often ignore the rest. Graham says flip that around. Start by examining the fund's expenses and fees, then consider how risky or volatile the fund has been, then look at the manager's reputation and track record, and only lastly check its past performance. Past performance can be misleading. High returns in the past might have come from high risk. By investigating costs and risk first, you ensure any fund you pick has a sound basis before you even look at returns. In summary, Chapter 9's takeaway is that mutual funds are a useful tool, especially for those who don't want to pick individual stocks. They promote saving and investing and can protect investors from some mistakes. However, you must choose funds with your eyes open, favor low-cost, well-managed funds, and be wary of chasing the latest superstar manager. For many investors, a simple index fund is actually the smartest mutual fund of all, aligning perfectly with Graham's principles of patience, consistency, and low expenses. We've covered managing our own mindset, Chapter 8, and letting mutual funds do some of the work, Chapter 9. But what if you feel you need more personalized guidance? Maybe you have a sizable portfolio, complex finances, or you just don't trust yourself to stick to a plan. That's where financial advisors come in. And Chapter 10 is all about getting the right kind of financial advice. Chapter 10, Getting the Right Financial Advice, How and When to Use Advisors. In Chapter 10, Graham discusses the role of the professional investment advisors, essentially brokers, financial planners, or portfolio managers, that an individual investor might turn to for help. The theme is knowing when you truly need an advisor and how to pick a good one if you do. First off, do you need an advisor? Graham gives a practical guideline. A full-time professional advisor, one who manages your money for a fee, usually only makes economic sense if you have a fairly substantial amount to invest, roughly $100,000 or more in 1970s dollars. Think perhaps a few $100,000 in today's dollars. Why this number? Because most advisors charge a percentage of assets or a set fee that would be too costly if your portfolio is small. If you have, say, $10,000 to invest, paying an advisor maybe 1% per year or a few $100s might not be worth it. You could invest on your own in low-cost funds and likely do just as well. Until you reach a sizable portfolio, Graham suggests sticking with simple low-cost index funds and basic strategies rather than hiring an advisor. This way, you aren't burdened by advisory fees while your nest egg is still growing. That said, many people seek financial advice not just for picking stocks, but for broader reasons. Lack of time, lack of confidence, or the complexity of financial planning, like retirement planning, taxes, estate considerations. Graham acknowledges that a good advisor can provide an objective second opinion and steer you away from emotional decisions, much like a personal trainer helps with discipline. The trick is finding an advisor who truly adds value and puts your interests first. What to look for in a financial advisor? Graham provides a list of questions and red flags so you can vet an advisor before trusting them with your money. 1. Understand their philosophy and approach. Ask, what is your investing philosophy? A good advisor should talk about long-term, value-oriented strategies or tailoring a plan to your needs, not boast about stock-picking genius or market predictions. If an advisor heavily uses technical analysis, chart reading, or claims to time the market's ups and downs, that's a big red flag. Graham explicitly says, if an advisor answers yes to using market timing or fancy technical signals, you as the investor should answer no to hiring them. An advisor should be grounded in fundamentals and realistic assumptions, not crystal ball gazing. 2. Scope of advice. Ask if they offer comprehensive financial planning or just investment management. The best advisors can help you with the whole picture, not only picking stocks or funds, but also advising on taxes, retirement planning, insurance, budgeting, estate planning, etc. If you need that kind of holistic advice, ensure the advisor has the expertise. If you only want help with your investment portfolio, that's fine, but make sure they won't ignore other important aspects of your finances. 3. What they invest in. Do they primarily use individual stocks, bonds, mutual funds, or a mix? This question helps you know if their approach aligns with what you're comfortable with. For example, if you want a very hands-off approach, an advisor who primarily uses low-cost funds might be appropriate. If you have a strong interest in stocks, you might prefer an advisor who can discuss individual stock picks. There's no one right answer, but the advisor's strategy should be something you understand and are on board with. 4. How they measure success and communicate. A good advisor should have a clear process for tracking and reporting your portfolio's performance. Ask, how will I know if we are on track? How often will we review my plan? Ideally, they provide periodic reports and even a checklist or plan that you can monitor. If an advisor can't clearly explain how they judge results, or if they hide the details, that's not a good sign. 5. Fees and costs. Always clarify how the advisor gets paid. Graham warns against advisors whose fees will consume more than about 1% of your assets per year. High fees can drastically drag down your long-term returns. Today, many fiduciary financial planners might charge around 1% or less, or a flat hourly annual fee. Be wary if someone's proposing something much higher or a very complicated fee structure. Also, be cautious if an advisor earns commissions by selling you specific financial products. That could be a conflict of interest. They might push products that pay them more, not what's best for you. 6. Realistic promises. This is crucial. Avoid any advisor who guarantees high returns or claims they will beat the market by a large margin. Graham notes a red flag. If someone promises an annual return much above, say, 8–10%, that's unrealistic and dangerous. No advisor can reliably deliver outsized returns without taking outsized risks, or they'd be running a hedge fund, not courting individual clients. A trustworthy advisor will speak in terms of reasonable goals, proper asset allocation, and risk management, not, "I'll make you rich quick." 7. Credentials and transparency. In Graham's time, an important step was the establishment of professional standards. He was influential in the creation of the CFA program for analysts. Today, one basic check is to ask, are you a fiduciary? Will you put my interests first legally? Also, in the US, advisors must provide a Form ADV, a disclosure document detailing their background, fees, and any disciplinary history. Graham specifically says an advisor who won't show you their Form ADV is one to avoid. That's like a doctor refusing to show their medical license. In short, do your due diligence. Check their qualifications, CFA, CFP, and etc. can be good signs, and ensure they have no serious black marks on their record. In essence, Chapter 10 teaches that while seeking advice is perfectly fine, even wise in many cases, you must choose your advisor carefully. A good financial advisor is like a guide and teacher, not a magician with secret tricks. They should help you make sensible plans, keep you from panicking in bad times or getting greedy in good times, and generally align with Graham's conservative, informed approach to investing. If you ever feel an advisor is pressuring you into something you don't understand, or trading excessively, or seems more interested in their commission than your welfare, step back. That's not the right helper for an intelligent investor. Conclusion. Chapters 8, 9, and 10 of The Intelligent Investor collectively emphasize a powerful trio of investing wisdom, mindset, method, and mentorship. First, mindset. Treat the market's volatility as your ally, not your enemy, by keeping emotions in check and thinking of the market, Mr. Market, as a servant offering you deals, not a guide to your asset's true value. Second, method. Use sensible methods like diversification and perhaps mutual funds to reach your goals, but choose those tools carefully. Favoring low-cost, broad-based funds or well-managed funds that align with your needs, rather than chasing the latest fad. Third, mentorship advice. Don't hesitate to get financial advice if you need it, but do so in an informed way. Pick advisors who are competent, honest, and loyal to your interests, and avoid those who aren't. By navigating market swings with calm rationality and only seeking outside help that truly helps while avoiding costly pitfalls, even a beginner investor can steadily grow their wealth. Graham's core message shines through. Successful investing is not about outsmarting the market in the short term. It's about controlling oneself, being patient and prudent, and making decisions based on value and knowledge rather than fear or greed. Armed with these lessons on volatility and advice, you'll be much better prepared to stay intelligent on your investing journey, no matter what the market or the media throws at you.